Hello and a happy new year and a warm welcome to this first edition of Econoday Unplugged in 2022. Mark Pender is on US East Coast, Max Sato is in British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. So it was the late economist John Kenneth Galbraith who once said, "We have two classes of forecasters, those who don't know and those who don't know they don't know." And who can argue with that after all the surprises of last year? Nonetheless, it's still important to at least try to identify the key themes or events likely to shape investor behaviour over the coming months and quarters. So with crystal balls in hand, that's what we aim to do in today's podcast. Sadly, we can't get away from COVID, which, with new cases once again at record levels in many countries, will continue to impact the global economy and financial markets for some time yet. And related to this, just how sticky high inflation proves to be will obviously be a major determinant too. But what are the other, possibly more local factors that might have a major say in how policy is delivered and asset prices move over the coming year? So let's kick off with Mark. Mark, there's a lot going at the Fed in terms of policy and personnel changes, but what do you think are going to be key things which are really going to impact the way the US economy performs and ultimately policies delivered this year?
Wage push inflation. That, I think, is on the top of the list. And today is Tuesday, January 4th, and we got the JOLTS report, which tracks quits. But this is from the Labor Department, and they are at an all-time record, 4.527 million, and that's in the month of November alone. And that's the record rate. And the quits rate is 3%, which is a record level as well. This is very closely watched by the Fed as an indication of people hopping for fatter pay. And this is in line with what we saw with the employment cost index at the third quarter, which soared to 3.7%, way beyond 1.2 percentage points beyond what it had ever been before. And Jerome Powell cited that as a very significant indicator that shifted the Fed to a more aggressive tapering. So I think that the old-fashioned inflation picture is with us right now. And so I think that's the top.
Okay, so if you're right, and you're talking about, say, this wage cost inflation is going to be a major factor, what do you think are the risks in terms of how many interest rate hikes we might see out the Fed? And the talks seem to be perhaps 3 this year. Do you think that's reasonable, too aggressive, or perhaps not quite aggressive enough?
Well, I think what we have to see is how inflation plays out. I think right now we're at a sensitive point, maybe a pivot point. Will it accelerate further? Will these inflationary pressures begin to steady? There may be an indication that that's happening. Some of the readings aren't the ones we got for December business inflation expectations from the Atlanta Fed. They came in at 3.4% for the year ahead outlook, and that's an all-time record. And that's been climbing, shooting up, 4/10 over the last several months. And it's never been in this territory, even though that sounds like a moderate rate still for this indicator, which goes back a dozen years or 10 years or so. It's an all-time record. But we are seeing a little bit of topping in the consumer year ahead expectations there. What we're seeing there, for instance, in the University of Michigan's numbers is 4.8%, which is actually down 1/10, as well as the 5-year expectations, which were also down 1/10. And will we see further acceleration? Well, we get something Friday with average hourly earnings, and this is part of the employment report for December, and Econoday's consensus for that is a 0.3 monthly gain, which is, that's a sizable gain, 3.5%. Extend that out at an annual rate. But compared to last year, the year-over-year consensus is 4.1%, which would be down 0.7. Now, this is skewed. Average hourly earnings are skewed because of the different component, how the employment labor market has restructured or has changed during COVID, lower numbers of lower paying jobs, although we're seeing, and by the way, going back to the JOLTS numbers, that was the quits rates, those were concentrated in public facing jobs, accommodations, restaurants, hospital services, those things. So any case, that's distorting average hourly earnings. Yet, nevertheless, however distorted, if it does come in 7/10 lower, that's going to help ease the pressure on the Fed. So, how many rate increases we get, I think next year, I think it's front loaded. I think we're going to get one early, but it's going to, how it plays out is to see if inflation does continue to rise, or whether it might level and plateau, in which case I think we'd have to maybe shift down those expectations.
Okay, fair enough. Let me ask a quick one in terms of fiscal policy. I guess looking around the world at the moment, it's going to be difficult for policymakers to decide the exact balance between what they should be doing on fiscal policy, because obviously we've got all these budget deficits through the roof, and most policymakers want to manage those down, so fiscal tightening. At the same time, we've got a lot of central banks talking in some shape or form about less accommodation or even higher interest rates, as you're saying, for the Fed. Now, we'll get these midterm congressional elections in November. Do you think the outcome of that, where it looks as if perhaps Joe Biden and co won't do too well, the implications for less maneuverability in terms of fiscal policy could have implications for what the Fed's going to do?
Oh, well, that's a lot of questions. Okay, so well, let's just take the first one, or the first premises, or the first. What's emerging here in the public debate is inflation. And it was interesting when Powell was being renominated. All of a sudden, these inflationary concerns were at the top of the list. Now, he had been downplaying. The Fed had been downplaying inflation as a transitory thing, and it didn't turn out transitory. Now, as he says, it's entrenched. So he went from there to there. And so that all of a sudden became a dialogue for his appointment, and he's coming up for renomination, and he's going to have to be on Capitol Hill, and we're bound to see all of a sudden inflation, as it was in the 70s, become the very, very top issue in the public dialogue. Do the Republicans have a heads up on that? The Trump administration was spending like crazy, so I mean they can go back to a traditional. The idea that the Republicans are more conservative fiscally, but Ronald Reagan didn't show that to be true either. So, but there is a deep, it built into the brain of the American voter is that Republicans are more fiscally responsible. Whether or not that's true, I think, is a completely separate question. But it could play in the Republicans' hands. It very, very well could, if inflation does continue to soar, and that could be a problem. We had an OPEC meeting today, and they didn't increase the amount of their quotas. So there's still, oil prices. That's another issue, and how OPEC, if it's thinking that Omicron is going to be a fading thing, and that more oil right now is good. But in any case, if oil does continue to rise, or if oil does spike up, that could be another factor, as it was back in the 70s. I don't know if we're getting back to that degree, but there's certainly all of a sudden some of these issues at play.
Okay, fair enough. Anything else from your side?
No, but just watch that employment report on Friday, and watch for the Econoday consensus at 400,000 non-farm payrolls and that 4.1% annual earnings rate.
Okay, keep your eye on wages, folks. Right, let's go north of the border then, and to Max. So Max, Canada, what are the key issues we should be looking at north of the border this year then?
Like in the States, Bank of Canada is under pressure to balance between employment and inflation, although policymakers are saying the new framework doesn't actually say it's a dual mandate. The Bank of Canada, under the old framework, has been paying attention to employment anyway. So we don't know what's going to happen to the economy in the spring, but a consensus here is a couple of back-to-back 25 basis point hikes. Mind you, Canada is a much smaller economy compared to the US or Japan's. So it would be easy to shift gears, adjust as things happen. If tightening is too harsh, they can reverse gears. So that's what we are looking at. We already had an election here, so politically, I don't see a major shift, but the government is now under pressure to deliver on the promise of turning the economy greener.
Okay, you mentioned, say, the kind of, I suppose, subtle shift, if you like, to a dual mandate, including the labour market. But as you also mentioned, it's really been the case that the Bank of Canada, like so many other central banks over the last, year or so anyway, have kind of had a more than a wary eye on what's been going on with unemployment anyway. So do you think this sort of a subtle move in terms of the remit will have any implications for perhaps the speed with which interest rates are hiked this year, if indeed they do go up, or do you think it's really neither here nor there?
I think there's an acknowledgement for many central banks that by themselves and observers that we can overshoot inflation, but if the policy framework is there, you could guide it back to the target range, not midpoint. Too much stress on midpoint, but in a range. That's easier for the economies like the US and Canada because we have already achieved the range, the inflation within those ranges. But that's another story for other economies like Japan. They have never achieved the 2% target.
Okay, so I mean, generally speaking, do you think there's a fair bit of optimism about where the Canadian economy is going to perform this year? They were certainly one of the first of the major central banks to, finish the quantitative easing program and indeed, discuss about possible timing of interest rate hikes. So, do you think, I suppose, looking at the way the economy might perform this year, given what's embedded in the market, are investors, if anything, the risks, are they too optimistic, or do you think they're too pessimistic?
You mean what the economy is going to be like in the second and third quarter?
Well, yeah, in terms of the overall shape of the economy, particularly over the second, obviously the first half, like everywhere else, we've got the COVID problems. If we can actually get through that, second half in particular, how you think that might pan out?
Not just in Canada, I think everybody has to keep in mind that we're not going to go back to where we were before the pandemic. The way we spend money, the companies and consumers, is going to be completely different. And so that means new demand needs new supply. We may not be able to see a smooth transition, but overall, economic growth will continue, and that's what both the government and the bank are counting on. Although one risk is, even though the bank will have to raise rates to cool off the inflation and asset prices, there's no sign that real estate bubble is going to ease off in Canada. So that needs a more specific government measure.
Okay, fair enough. I must say, house prices, I guess, are going to be potentially, at least the housing market, potentially one of the big risks as far as 2022 is concerned for a number of economies. Right, thanks for that, Max. Okay, let's move to Brian then. Brian, let's kick off with China. Before you say your bit, let me ask you just a question about some of the latest move we've had out there. In particular, we saw the benchmark loan prime rate being cut, the back end of last year. Is that sort of further indication that investors should be concerned about the slowdown taking place in the Chinese economy at the moment?
Yeah, well, I mean, I think policymakers in Beijing are worried about just the fact that growth has stalled in many parts of the economy, and really there doesn't seem to be a lot of momentum going forward, given that officials still very much have this zero COVID approach to dealing with various outbreaks. So, if there's a factory where there's an outbreak, they'll close it down. If there's a port with an outbreak, they'll close it down. If there's a whole city, they go into lockdown. So that's really, I think, one of the major drags on the Chinese economy's performance going forward. We've also got other things that they've been doing to try and curb energy consumption. So right across the board, there's a lot of sort of weights that are sort of bearing down on the Chinese economy, and so they're trying to offset that with some little tweaks here and there. But it's really, I'm sorry to be boring. It's really about the virus, though. It's going to be the big factor that determines whether you can see just a real shift in performance in the Chinese economy. If we sort of manage to get on top of it, there is, I think, scope to really see a big bounce back.
Yeah, well, you've already touched on it already, but I was going to ask you about. I mean, this zero COVID policy that the Chinese authorities are operating with at the moment. You kind of, really kind of answered the questions going to raise about, what's it look like for this year? Presumably, if they're going to continue to operate with this policy, then the risks for global inflation and the fact that the production and the supply of raw materials or semi-finished manufacturers coming out of China isn't going to be what it could be because you've got so many people stuck indoors, wherever it may be, is going to be a factor helping to maintain inflation at higher levels than might otherwise be the case.
Yeah, absolutely. The supply chain problem, is basically a made in China sort of problem. It's sort of the source of the problem really for all around the world. And but looking on the positive side of things, if we do sort of see light at the end of the tunnel for the pandemic, then it could really switch around pretty quickly. But in the meantime, that's definitely a risk that I think everyone has to take into account.
Okay.
I mean, looking at the other thing that I would mention for China is just also, we've seen the top leadership in Beijing be quite belligerent on many fronts over the last sort of 12, 18 months. And, that's obviously leading to a lot of concerns across the region, whether it's, the Japanese government, the South Korean government, all around concerns about what China is sort of planning longer term, particularly with Taiwan. There's been a lot of, little incidents and, there'll be an aircraft sort of going pretty close into Taiwanese airspace, that sort of thing. So that's also, I think, a big factor that people will be watching, over the course of the year.
Yeah, geopolitical instability. It's your part of the world, at least out in Asia and other parts as well. Can I also ask you quickly before you move on to the rest of your region, in terms of the foreign exchange, we saw the Central Bank of China hiking their bank's FX requirement ratio. Middle of last month, remember rightly? I think if I remember rightly, they also increased back in June of last year. And it does seem, given the nature of what they're doing, it's kind of aimed at preventing the Chinese currency from appreciating that much further. Are we at the stage now, perhaps because the economy is slowing down, that they've become more sensitive to the level of exchange rate, do you think?
I think so. I mean, that's one of the levers that they do have to pull if they do want to try and provide a bit of support to parts of the economy is just to reduce the pressure on exporters from currency appreciations. It's probably not the most important one that they'll use, but they'll tweak that going forward as well. And I guess it's kind of interesting in that they're a bit of an outlier at the moment in that elsewhere in the region we are seeing moves towards tighter policy, but they're still very much in that mode of keeping policy pretty accommodative.
Yeah, interesting how these dislocations in policies are all starting to come through. Okay, so you mentioned Taiwan, which I think is certainly key aspect people should be keeping an eye on. The other big risk, I suppose, at least as far as China's concerned, and perhaps in terms of contagion effects, going back to Evergrande, not paying coupon payments and so forth. What do you think is the state of the residential property area or sector in China now, and how much of a risk is it to both the performance of the Chinese economy and indeed the region as a whole for this year?
Yeah, I kind of forgot to mention that as one of the factors, but it's sort of been just a slow-moving crisis, really, hasn't it? It's we've been talking about Evergrande now for it seems like 6 months at least, and what they tend to do is manage these problems internally, and they'll lean on other real estate developers to take on some of its balance sheet, or they'll lean on banks to go easy on them to a certain extent. So I think this is part of a long-standing sort of trend where when these sort of problems do emerge, Beijing tries to manage it and sort of get on with it. And my guess is that's what's going to happen here eventually as well. But it does mean that going forward, the whole property market is weaker than what it would have been.
Okay, fair enough. Let's move across to your home territory then, Australia. What are the big issues facing, well, RBA, the government? Indeed, you've got federal elections, haven't you, in May coming up? What's the kind of, the big risks associated with Australia this year?
Well, I mean, right now it's hard to see anything playing a big role other than where we are with our wave of Omicron cases. So that's hit us very hard over the last 2 or 3 weeks. Just cases building very rapidly, and we're seeing governments and leaders trying to resist the idea of going back into lockdown. There's been calls from some commentators and some experts that that's what needs to happen, but I think our leaders and a lot of the public are just really averse towards that idea of going back to lockdowns, to managing this. And so we're just looking at the case numbers every day, and we're trying to be amateur epidemiologists and see what happens. What the South African data are showing, what the UK data are showing. Is this thing going to peak very soon and then start to fall back very quickly? How serious is the pressure on our hospitals? So that's really taking up all the airspace at the moment, quite understandably. So hopefully, if some of the more positive, optimistic scenarios play out, things might be better in a month, and we can start thinking about, okay, we can live with this virus and go on with our lives. But right now, there's a lot of uncertainty about it.
Yeah, true. You and everywhere else as well. Okay. Anything else you particularly want to mention from your part of the world? I suppose quickly, I would only ask about the RBNZ. I mean, clearly been one of the most hawkish of the central banks amongst the larger ones during the course of this year, or last year, I should say now. Anyway, is it still a case of looking for additional tightening during the course of this year?
Yeah, I think they'll move in that direction when they feel they can. As long as the virus doesn't derail any economic recovery that we're seeing over there. I think their bias is definitely in that direction. And so, but just on the Reserve Bank of Australia as well, they're going to be coming under increasing pressure, I think, to move perhaps more quickly than they anticipate on policy rates. So at the moment, they're still saying that they don't think anything's going to happen this year. It's a 2023 story, but the markets are definitely pricing in expectations that they might have to move earlier. There's been a lot of property market appreciation over the last 12 to 18 months. So that's raising eyebrows about whether policy rates need to go higher. And similar to what Mark was saying, wage pressures are also definitely building here in Australia. So lots of reports of shortages of labour in parts of the economy. And so just this idea that interest rates are sort of set and not going to move anytime this year, I think that's going to be a real point of attention in Australia over the whole year. And as you mentioned, also we do have a federal election, so that's probably due by May of this year. And again, I think the big issue that will be resolved after that is just what sort of fiscal situation we're going to have for it. Are we going to be sort of working to repair sort of the public finances after what's been done over the last couple of years?
Right, okay. And just one last quick one for you before we go on to Max in Japan. To ask you about the RBA, so I should have asked you before, but the decision to abandon yield curve control last year essentially seemed to be really dictated by what bond market traders thought. Given it seems something of a U-turn by the RBA, I mean, are investors now going to believe the central bank's forward guidance in the future, do you think, or has it been undermined?
I think there might be more skepticism about it, and I think the RBA can legitimately say, look, we're just putting out our best estimates of where we think things are going, and obviously things can change, and when that does, we'll review our guidance. But I think So investors are going to be making their own judgments about where they think that guidance is going to be going, rather than just assuming that that guidance is not going to change over the course of the year. And that's fair enough. No, I don't think that really undermines the credibility of the RBA. It's just basically saying that, you know, circumstances are evolving pretty quickly.
Yeah, who would be a forecaster in this world? Okay, thanks for that, Brian. Okay, Max, Japan. Now, look, you've got a new prime minister, but is anything really changed in terms of the outlook for 2022?
I don't think so. He's basically inherited both the economic challenges and available toolbox, policy measures. And he has already said that this is going to be a long-term process. So we don't see anything changing dramatically, but basically Kishida's going to first raise the government-regulated wages for caregivers, nurses, and the government will probably continue guiding or raising the base wages for every prefecture. So that's a good move. And the previous governments, administrations have been already pushing for equal pay for equal work. But fundamentally, although the government has been pushing big businesses to raise wages, the companies have been reluctant, saying, you know, the outlook is uncertain. But you can talk about uncertainty anytime. So there's nothing really what government can do, and instead they're going for an easier way of basically making the central bank print as much money as it can and giving cash handouts. But given the household's own uncertainty about a social security network in the future, they're not going to spend that money. They'll probably save for kids' education, for their retirement. So there's not a lot what the government can do except keep adjusting the reform they did years ago and allow people to survive instead of going through the poverty line.
Jeremy, this is Mark. Can I ask a question?
Yeah, of course.
Max, you know, is there did I catch a hint that there's a skepticism in the Japanese public about the financial prudence of Bank of Japan policy?
Maybe not much from the general public, because the recent surveys show that they don't really know what the bank is doing, and the ratio of people who know that the Bank of Japan has a 2% target has been declining. So it's more of little to no interest. And what the Abenomics did was to push the stock prices, guide the yen weaker. But the end result is maybe that you have to have the cash to benefit from the stock market rise, and the majority didn't feel that they got richer. So yes, there's skepticism. Yeah.
Can I ask you, Matt? I mean, one, I suppose, I don't know, if you believe that interest rate differentials matter in terms of the way foreign exchange markets move and so on. We've seen this year with, the increasing speculation about Fed's going to abandon its quantitative easing and ultimately tighten. When you look at Japan, nothing ever seems to happen. One of the supposedly easy calls for 2022 is, well, guess what? The dollar must appreciate further against the yen. Do you see any risks stemming from the Japanese economy or politics or whatever it may be, which may make people who believe that dollar yen will strengthen have got it the wrong way around?
As long as dollar yen is in a range between 100 yen to the dollar to 120, I wouldn't think it's going to be a huge risk. And even if the yen appreciates towards 95, or the dollar appreciates toward 125, I don't think the policymakers will have to respond in a way, except that they have to do something about supporting the lower income people when inflation keeps rising. Although the on the basis of CPI, it's going to be only about 1% this year, but cost of living is rising.
Okay. Anything else from Japan?
There's going to be upper house election by July, so I think people will be watching what the government's going to do before the election. Are they going to just give more cash handouts to gain votes, or are they going to be more smart about how to support the economy and support the workers? So it's going to be interesting time, but I'm afraid the opposition parties are still divided and fragmented. So at this moment, probably the ruling parties led by the LLP will win.
Okay, brilliant. Thanks for that, Max. Right, well, let's round off the trip around the world with Europe then. Monetary policy first, I guess. I mean, at least on paper, seems to be relatively straightforward to pose the idea that ECB policy is really going nowhere in a hurry. But bear in mind that there are some growing splits on the governing council about what should be happening to, well, certainly quantitative easing and ultimately interest rates in the Eurozone as well. We've had calls now from Germany, Dutch and the Austrian central banks all suggesting that it's time for a move away from negative interest rates. And these splits certainly aren't going to be good, I think, as far as the stability of the euro is going to be concerned. Clearly, when you do get differences, major differences within a central bank policy decision-making body, it can't be good news for the individual currency. In addition to which, I guess, I suppose I tend to look at the negative side for the euro. It's going to be important year for the eurozone in terms of politics, which ultimately might well weigh on the currency as well. In Germany, of course, the main change for 2022 is going to be that there's no Angela Merkel anymore. We now have a new left-leaning government in Germany, the so-called traffic light coalition, which comprises Social Democrats, the Greens and Liberals. And that'll be the first time we've ever had that. We also have a new Chancellor, Olaf Scholz, and now he's a former finance minister in the Grand Coalition that Merkel's Conservatives had with the SPD. But nonetheless, he's walking down the line of talking about increasing the minimum wage by up to 25% or so, a proposal which has been heavily criticised by the Bundesbank. It may also be the case that he adopts a slightly less aggressive stance in terms of whittling down these overshooting budget deficits across all of Europe. So it's going to be an opportunity perhaps for some of the other Eurozone countries to start to get some of the lead coming out of overall European policy. Now, regards that, we'll have French presidential elections, the first round of which will be on the 10th of April, and possibly, if needed, the second round will be on the 24th of that month. Emmanuel Macron, the current president, is favourite to win, but it's certainly not a done deal, and particularly if additional COVID restrictions in France, which are not going down at all well at the moment, it's certainly possible he could lose. But if he does win, then it seems as if there's going to be at least much more of a tie-up with Italy, where the two countries will try to have a bigger say in what's going on with Eurozone policy. So that in itself is going to be a test of a new German chancellor to see how much clout he can still maintain. And also it could mean only a gradual phasing in of the Stability and Growth Pact. This is currently being suspended, and this is the program which effectively caps the amount of borrowing and overall debt that the various Eurozone governments can to have at any particular time. So it could lead perhaps to a slightly looser fiscal policy. Also, from the political side, let's pick on Italy. We have presidential elections which are due to start on January the 24th. So what, you might say, and that's normally the natural response because they don't tend to matter that much because the post is largely ceremonial. But this time it could matter because the current president says he won't be standing for another term, which he could do if he wanted to. That's Sergio Mattarella. And the leading candidate to take that position is the current Prime Minister and former ECB chief, Mario Draghi. Now, if Draghi gets it, then it would mean it would trigger snap elections and potentially a new period of political instability at Italy at just about the worst possible moment. Draghi has been recognised as bringing about, well, ultimately, by Italian standards, a good deal of political stability. And it may well be that he's going to be needed as the Prime Minister to ensure that the funds due under the European Union's Next Generation Recovery Programme are allocated properly. So what happens in these presidential elections could actually be quite important in terms of the way Italy shapes up. Boil it all down to one of the big risks, I guess, for Europe at the moment are some of these growing European Union fault lines. Oh, okay, they've already lost the UK, courtesy of Brexit. And as we recall this podcast, there's still a very important standoff between Poland and Hungary versus the EU Commission over the likes of judicial independence, the ineffective prosecution of corruption and indeed deficiencies in public procurement. Now, at the moment, it boils down to a case of who actually has the final rule when it comes to judicial matters. Is it going to be the European Supreme Court, which should be the case if you remember the European Union, or for the likes of Hungary in particular, but also Poland, the national jurisdiction? Now, at the moment, there's a complete standoff between the two sides, and it's very difficult to see how that's going to be rationalised. The EU Commission has almost got to the stage whereby it's threatening to withhold some of these recovery funds from the two countries, particularly Hungary. And if they can't resolve the position at the end of the day, even though Hungary and Poland don't want to lead the European Union, there's at least some kind of tail risk that that could happen. And if it looked like that were to be the case, there's certainly be contagion effects across some of the Eurozone countries, and that could be a major negative as far as the Eurozone currency itself is concerned. So I think politics could well be one of the key risk factors, certainly, as far as Europe, for Europe's concerned at the moment.
Speaking of politics there, what is that risk maybe diminished a bit by Putin and Ukraine? Hungary and Poland are not big fans of Russian hegemony.
Good question. Okay, let me move on to Switzerland with regards to that. Yes, that's an excellent point. And I think, you say, talking about politics, it is going to be an important factor for Europe. And you mentioned there's obviously huge tensions at the moment on the Ukrainian border with Russia, with genuine concerns that Putin may about to press the button in terms of invading Ukraine. Now, so long as we've got that, yes, it's going to make Poland, in particular, all the less likely to want to leave the European Union. Nonetheless, so I think one of the key follow-throughs from that is that when we look around, opportunities for trading in Europe, the one that stands out as being more than ever the safe haven currency for the European market is the Swiss franc. Now, if folks remember, we talked a little bit about it in the previous podcast in December when the Swiss National Bank had its monetary policy assessment. And the only real surprise coming out of that was the fact that they didn't seem to have too many concerns about what really is extremely strong Swiss franc. In previous years, when we've had the Swiss franc trading at current levels, they've gone out of their way to point out that it's basically hugely overvalued. Well, now they're just saying basically it's a strong currency. And not only that, intervention from the Swiss National Bank has been relatively mild compared to what we've seen previously when we've been trading around current levels. So there are signs now that the SNB has undertaken what amounts to a fairly significant shift in policy, whereby it's prepared to accept, significantly stronger levels of the Swiss franc than what market participants have been prepared to assume they were prepared to accept previously. Now, if that's the case, it could well wave the green flag to even further Swiss franc strength. As you mentioned, just going to the geopolitical situation in Eastern Europe at the moment, if that were to blow up further, we could see this Swiss franc now gain ground considerably if speculators believe that, well, look, the Swiss National Bank doesn't care about the currency anymore. So I think in terms of looking for potentially volatile currencies within the European bloc, then the Swiss franc is very much one worth looking at. So, yeah, politics, certainly as far as Europe's concerned, going to be one of the major factors, I think, as far as we go this year. And also just sticking in terms of this EU link, although it doesn't get too much press coverage at the moment, the European Union's relationship with Switzerland is also under significant pressure at the moment. That's really due to current negotiations over Switzerland's place with the EU internal market. Brussels at the moment has a whole load of bilateral trading agreements with the European Union, which almost amounts it to being in the European Union itself. These stretch back about 50 years or so. And effectively, it's got to the stage now whereby the European Union wants to see these things being tightened up. The Swiss won't stand for it. And so there's a chance that some of the current close relationship between Switzerland and the EU could start to dissipate. And were that to happen, that could lead to a huge amount of volatility as far as some of these European cross rates are concerned. Right, let me quickly move on to the UK before we spend too long. UK, again, don't like saying it, but politics are probably as important as anything else for the UK markets this year. And that really boils down to a couple of things. Firstly, the risk of a hard Brexit. This fight over the Northern Ireland Protocol, this thing written down in the old Brexit treaty, and indeed French fishing rights, has led to a major deterioration in Anglo-European Union relations. Indeed, there's talk of an outright trade war, which essentially would boil down to a hard Brexit. If that were to happen, neither side wants it, but again, the discussions or negotiations aren't really getting anywhere at the moment. That would be really bad news both for European growth prospects and particularly for the UK as well. So the pound could be hit hard, but again, more bad news for the euro, which would certainly help the dollar. In addition, domestic politics in the UK, well, we got Prime Minister Boris Johnson, who's been on a honeymoon ride really since he won the last election. Recent developments have seen his opinion poll rating completely crash, to the extent now there's talk about a possible challenge to take over his position as head of the Conservative Party and Prime Minister as well. Next election, UK election, isn't due until May 2024. But if we get a lot of internal disruptions in politics, again, that's not going to be good news for the pound, even though it still seems likely that the Bank of England will be amongst the forerunners in terms of raising interest rates. That said, of course, COVID, as Bram was talking about, and everybody else talking about, still going to have a major say in what happens to UK monetary policy. Okay, that's it for my bit in terms of Europe. I'll just quickly mention some risks that other people have talked about, or we haven't mentioned yet. We probably should do. Oil prices, I think, as Mark was talking about, what's going to happen to those, clearly instrumental in terms of headline inflation. Where do we go from here? Well, just to indicate how uncertain markets are, if you believe JP Morgan, they're currently forecasting oil prices, the benchmark numbers are going to go up to $125 a barrel in 2022 and $150 a barrel in 2023. If that's right, inflation's really got a lot harder to go. But if you believe what the US Energy Information, the EIA, is saying, they see oil prices averaging just $70 a barrel this year. So bottom line, no one's got a clue.
Well, the EIA isn't in the market, and JP Morgan is.
That's right.
I mean, are they just calling their own market position?
I really don't. Who knows? But it just goes to show the kind of split we got on this. For underlying inflation, I think a number of people talked about wages. High and sticky inflation clearly lead to risks of second round effects, particularly if we see these participation rates in labour markets staying low and labour supply remaining tight. Vaccine success is crucial. So far, they've done pretty well rolling out these vaccines for COVID, and with the approval of some pills now to treat infections as well, investors have become clearly much more relaxed about COVID. Look what's happening to the equity markets at the moment. But as the Omicron variant has demonstrated, if we get another variant coming out, which the vaccines don't handle so well, we're going to be back to square one. Housing markets, prices are too high, really, in too many countries at a time of probably rising borrowing costs. So we're going to get a hard or soft landing there. And supply chains, well, as we touched on this too, but once the current problems are over, what are companies going to do in terms of sourcing raw materials and intermediate goods? Globalization has helped to keep prices down. We're going to get domestic sourcing taking place. Almost certainly that's going to help to keep higher prices and also higher inflation as well. What else should we mention out of this little lot? We mentioned Taiwan. Keep an eye on that. And also, I suppose the other thing is just emerging markets as well. We get the Chinese slowdown, a strong dollar, and central bank tightening across EM economies to contain inflation pressures. Then some of these emerging markets could well be under pressure. So it could be the safe haven currencies and safe haven assets in general, which tend to outperform.
I have a question about the pound.
Yeah.
Are the Tories bulletproof? I mean, just get someone else instead of Boris Johnson. And has Labour made any, substantial structural moves that could change the view of policy?
Well, I think the answer to that is the Tories are certainly no longer bulletproof. Boris Johnson has survived as long as he has because he's seen to be this kind of Teflon character. Any bad news come out, it just falls off him. It doesn't really matter. But he's standing now is by far and away the weakest it's been in a long time. We'll have some local council elections coming up this year, particularly in London. And if he fares badly in those, there's a real chance he could be out before the end of the year. In terms of Labour, their policies don't really seem to be attracting too much attention or appeal, but it's more to do with the Tory party. The Tory party at the moment are losing rapidly ground in the opinion polls. And if there were ultimately to be a vote of confidence in the government, which is probably unlikely, but certainly not an impossibility, we could actually end up with an early general election. And that certainly would not be good news for the pound. Right. Anyone for anything else? Silence is
got. So that from Japan, Kuroda's terms. This is his second 5-year term. Is going to end in April 2023, and maybe more importantly, he's one of his deputy governors, Amamiya. He's a Korea central banker. His term is going to end a little earlier, actually, March 2023. So there's going to be a search committee, and it's going to be interesting what's going to happen after Kuroda. Whether Japan's going to change the inflation target from 2 to in a range or lower it.
Changes the inflation target. That's becoming the name of the game these days, isn't it? Okay, Bron, anything from your side? Probably not, I'm guessing from that. Okay, then. Well, that's it for this week. Well, only time will tell what actually lies in store for investors this year. But to keep on top of what's going on now, do take a look at Econoday's global economic calendar, which will continually update you with all the key market moving data and events. And indeed, for a quick snapshot of how the main economies are faring versus market expectations, don't forget to follow Econoday's Economic Consensus Divergence Index, which stills all the recent data into a single user-friendly measure, updated in real time, a real bonus. And with that, on behalf of Mark, Max, Bron, and myself, thanks as always for tuning in and the podcast. We'll be back again next week. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.